All right, welcome back to Talk Tickers. This is the show where we try to strip away all the corporate fluff and just get right to the numbers that actually matter.
And today we have a really interesting one. It's Tuesday, February 3rd, 2026, and we're breaking down the Walt Disney Company's Q1 earnings call, which happened yesterday morning.
And it is a fascinating, almost confusing situation. Because you look at the headlines, you see a bottom line beat, you see revenue growth. You'd think it was a home run.
You'd think so. I mean, we're looking at a classic disconnect between what the spreadsheet says and what the market is actually hearing. Disney delivered a beat on earnings. They proved finally that streaming can actually be profitable.
And yet the market absolutely hated it. Let's just get right to it. The stock closed down, about 7.3%?
Yeah, landed at $104.45. A really sharp sell-off.
So that's our mission for this deep dive.
Yeah.
Why on earth did the street dump a company that just posted record revenue and experiences and beat on earnings?
That is the big question. And to get there, we have to look at this two-speed story that's developing. You've got streaming just hitting its stride, but then you have this sudden fog rolling in over the parks.
And on top of that, this kind of controversial change in how they're reporting their numbers, plus some really specific details about a new AI partnership with OpenAI.
Exactly. It's a lot to get through.
Okay, so let's start with the hard numbers. Give us the snapshot. What did the P&L actually look like?
So here's the what. Adjusted EPS came in at $1.63.
And the street was looking for what, like 150 something?
Yeah, consensus was around $1.57. So on paper, that's a beat, a solid beat. Revenue was up 5% year over year to $25.98 billion. Again, looking good.
Okay, so top line's growing, bottom line beats, so where's the problem?
It's the operating income. Despite all that, total segment operating income was actually down 9% year over year, came in at $4.60 billion.
Oof, that's a bad look. How do you grow revenue but shrink your operating income by almost 10%?
Well, a big piece of that puzzle is sports. ESPN's operating income dropped by $56 million, and a huge chunk of that $110 million was a direct hit from that temporary YouTube TV carriage dispute.
Ah, right, that blackout period. But that feels like a one-off thing, doesn't it?
It is, but it also shows you how fragile that whole system is. You add that to the higher rights costs for college football and the new WWE deal, and yeah, it gets expensive.
So it's like we've seen a total role reversal just a few years ago. Streaming was the problem child, and now it's the star of the show.
It's an incredible turnaround. Entertainment SVOD's streaming revenue is now over $5 billion, up 11%. But the real story is the profit. $450 million in operating income, an 8.4% margin.
Let's just pause on that for a second, because 3 years ago, this segment was just lighting cash on fire.
It was a black hole, losing nearly $4 billion a year. To swing from that kind of loss to a $450 million profit in one quarter is, wow, that's wild. And they're sticking to their target of a 10% margin for the full fiscal year.
So how they do it? Is it just more subscribers?
Not really. And this is where things get interesting on the transparency front. The profit isn't coming from just adding more bodies. It's coming from pricing power and bundling.
The bundle is back.
It's totally back. They're pushing the duo, the trio, all those bundles. Because if you have Disney plus Hulu and ESPN plus Kaida, you're just not going to cancel. It kills churn. They've turned a monthly choice into a utility you just pay.
But they stopped telling us how many subscribers they have, right?
Yeah.
Which always feels a little sketchy.
They did. And the bears are all over that. Disney isn't disclosing the raw sub numbers in the same way.
So they've created a black box.
They have. But management's argument, and it's a fair one, is that the land grab phase is over. It's not about headcount anymore. It's about ARPU, the average revenue you make per user. They're basically saying, judge us on the profit. And frankly, with $450 million of it, they've earned a little room to say that.
And the content is there to back up the price hikes. I mean, Zootopia 2 did huge numbers.
Massive. Yeah. $1.7 billion. Avatar also crossed $1 billion. But you have to stop thinking of these as just movies. They're subscriber acquisition tools. When those films hit Disney plus ABBA, the engagement, the hours watched, it goes through the roof.
The flywheel is finally turning. But, and this is the big but, if streaming is doing so well, why did the stock get crushed? Let's get to the anxiety around the parks.
And this is exactly that two-speed story. The Parks and Experiences segment. It hit a record. $10 billion in quarterly revenue, up 6%.
$10 billion in one quarter. That's a staggering number. So what is the street so scared of?
It boils down to one very specific comment from management: softness in international visitation to U.S. parks.
Why is that one distinction so important? A tourist is a tourist? No.
Not at all. Not to the bottom line. International travelers are the whales. They stay for 10, maybe 14 days. They buy all the merchandise. They book the expensive character breakfast. When they don't show up, you lose all your highest margin business.
And I'm guessing management didn't sound too confident about when they're coming back?
Not at all. They admitted they have limited near-term visibility on the return of that international traffic.
And limited visibility is just poison to an investor. It means we have no idea.
Exactly. The market hears that and just assumes the worst. Now, to be fair, Disney's pivoting. They're pumping marketing dollars into attracting domestic visitors to fill those parks.
Is it working?
To fill the parks, yes. But a local from Orlando just spends way less than a family from London. The revenue mix gets worse. They said forward bookings are actually up 5% for the year, but the market is questioning the quality of those bookings.
So the fear is they're just giving discounts to locals to keep the turnstile spinning, but the profit per person has fallen.
That's the concern in a nutshell. Volume versus value. And until that international picture gets clearer, the stock is going to have a hard time.
But it's not all about the theme parks, right? The cruise line seems to be a real bright spot in this segment.
Oh, absolutely. This is their countermove. They're expanding the fleet aggressively. The big news is the Disney Adventure, which sets sail from Singapore on March 10th. It's their first ship based in Asia.
That's a smart hedge. If the international tourists won't fly to Orlando, take the Disney experience to them.
That is precisely the play. The fleet's going up to 8 ships, with more on the way. It's a huge capital investment, but the moat is enormous. It's a captive audience that spends a ton of money.
Okay, let's switch over to strategy. They made a big change to their reporting structure that seemed to make some analysts pretty nervous.
Yeah, the one entertainment idea. They've stopped reporting linear networks, cable TV as a separate thing from streaming. It's all just one big entertainment bucket now.
So cynically, they're just hiding the decline of cable TV.
The cynical take is yes, absolutely. You blend the dying business with the growing one, and the overall numbers look okay. It makes it much harder to model the decay of linear TV.
But is there a non-cynical reason? A real business reason?
There is. It does reflect how people actually watch stuff. You might watch a show live on ABC or stream it the next day on Hulu. To Disney, it's all becoming one pool of content to monetize. They want the market to stop focusing on the pipes and just look at the content.
And they also cleaned up some other stuff, right? The Fubo and Hulu deal.
Yeah, that was a quick mention, but important. They're basically combining some Hulu Live TV assets with Fubo. Disney now owns about 70% of that combined company.
Tidying up the portfolio.
Exactly. It consolidates their position in the live TV streaming market, the skinny bundles.
Okay, but this is what I found really fascinating. The AI partnership. We hear a lot of buzzwords, but this felt real. The OpenAI Sora deal.
This was not just fluff. They gave actual details. It's a licensing agreement to use Sora, OpenAI's video generation model.
And they put up some very specific guardrails, which I thought was smart.
Very smart. So the deal lets users create 30-second videos using a library of 250 Disney characters. But, and this is the key part, no human voices and no human faces.
So I can make a clip of Stitch doing something, but I can't make a deepfake of Chris Evans as Captain America.
Precisely. It protects them from issues with actors and unions, but still lets them dip their toes into user-generated content.
What's the strategy? Why do they even want this?
They want to build their own TikTok inside Disney Plus Bowl. That's the goal. Right now, a kid finishes a movie, closes the app, and goes to YouTube Shorts or TikTok. If Disney can get them to stay inside the app making and watching 30-second clips of their favorite characters, that's a massive win for engagement.
That's actually a pretty brilliant way to fight for attention without giving up control of their IP.
It is. Iger talked about letting subscribers create this stuff right on the platform. It makes the service stickier. It's a bold move for a company that is famously protective of its brand.
So let's bring it all home for the investor. The market sold off, but what does the actual guidance look like? Is it bad?
See, that's the thing. The guidance is strong. They reiterated double-digit adjusted EPS growth for the full year. Cash from operations is a monster, $19 billion.
Wow, that's a lot of cash.
It is. And they're putting it to work. They're targeting $7 billion in buybacks this year, and they already bought back $2 billion worth in this quarter alone. They're betting on themselves. Big time.
And any word on the future? On Iger's succession plan?
He talked a lot about how the fixing is done, and now it's time for building. He definitely dodged naming a successor, but he made a point of saying the company is now structurally ready for a new leader.
Was there a hint in there somewhere?
I think so. He specifically pointed to the studio heads, Bergman and Walden, and said that accountability for streaming profits now sits with them.
Ah, so he's basically saying, I've cleaned up the org chart. The next CEO won't be inheriting a 5-alarm fire.
That's exactly it. He's signaling stability. But the market isn't buying it yet. The message from the 7% drop is clear. We believe you on streaming, but we're not paying up for this stock if the parks engine is having problems.
It's a proven market. All right, let's move to our favorite segment.
Time to make the lawyers nervous.
Always. This is not financial advice segment. We pitch a wild but plausible trade idea based on the data from the call. This is purely for entertainment. Please do not actually do this.
Okay, lay it on me. What's the trade?
I'm calling it the Singapore Sail Away ARB. The trade is you go long Disney, specifically for the cruise line exposure, and you go short a basket of domestic hospitality REITs that are exposed to Orlando and Anaheim.
Okay, I'm intrigued. Walk me through the logic there.
It's a pure play on the two-speed story. The long side is simple. That new ship, the Disney Adventure, launching in Singapore, creates a whole new Asian revenue stream that is completely insulated from the U.S. international tourism problem.
Right, because those customers are right there. They don't need a transatlantic flight to spend their money with Disney.
Exactly. And the cruise line is expanding like crazy. It's a floating theme park with a captive audience and super high visibility revenue. You can't leave.
I like it. So what's the short side? Why the REITs?
Because management handed us the signal on a silver platter. International visitation softness.
So if the tourists from Europe and South America aren't coming to Disney World,
They sure aren't staying in the hotels on iDrive either. And here's the kicker. Disney can pivot. They can offer deals to Florida residents to fill the parks, which they are doing.
but the locals drive home after the fireworks.
Exactly. They don't fill the hotel rooms. So Disney keeps its attendance numbers looking okay, but the entire hotel ecosystem around the parks gets crushed. You're betting on the divergence between Disney's resilience and the hotel's total dependence on those missing international travelers.
That is dangerously plausible. You're using their own warning against the rest of the travel sector. I like it, but again, just an idea, people, not actual advice.
Absolutely not.
Okay.
Okay, so let's wrap this up. What's the final thought here?
The recap is simple. Disney beat earnings, they actually fixed streaming, and they are swimming in cash. But the market punished them because they're terrified about a slowdown in the parks.
It really feels like the company's future is this weird combination of giant physical steel ships and these little 30-second AI-generated video clips.
It's a total clash of heavy industry and bleeding-edge tech. If they can pull both off, the stock is a bargain right now. If the parks stumble, it's a value trap.
And that's where we will leave it. Thanks for listening to Talk Tickers. Keep watching the tape.
See you next time.